Hi, and welcome back to our edition of Technically Speaking. My name is Violeta Todorova, and I'm Senior Market Analyst at Legacy FX. After May, US CPI unexpectedly accelerated, hitting a 40-year high. Last Wednesday, the Federal Reserve hiked interest rates by a whopping 75 basis points instead of 50 to tame red-hot inflation and flagged a faster pace of future rate hikes. Last week, the S&P 500 experienced its biggest weekly loss since the COVID-19 meltdown of March 2020, as fears that more aggressive monetary tightening by central banks could trigger a recession at some point. The S&P 500 has been in free fall as the Fed envisages steady interest rate hikes till year-end, bringing the federal funds rate to 3.4%, well above 1.9% expected in March, and to 3.8% next year. Last week's Fed projections show economic growth to slow below trend to 1.7% this year, below 2.8% estimated in March. The growth outlook was also lowered for 2023 to 1.7% versus 2.2%, and for 2024 to 1.9% versus 2%. The slowing economic growth is leading to a rise in unemployment, with the next 3 years revised higher. The unemployment is projected to rise to 3.7% by the end of this year and continuing to rise to 4.1% throughout to 2024. The Fed objective is to bring inflation down to a universal target of 2% while keeping the labor market strong. The market is currently pricing in another 75 basis points hike in July and then 50 basis point increase in September. The economic calendar is light this week, and Fed Chair Jerome Powell would be on the spotlight on Wednesday and Thursday when he testifies before the Congress, justifying the biggest interest rate hike since 1994. Several Fed officials are due to make appearances during the week too. Traders are also awaiting US PMIs and updates on the health of the real estate market as signs of rapid cooling have emerged. Having witnessed downbeat US data of late, preliminary readings of June PMIs will be crucial. Since it peaked at 4,800 points in January 2022, the S&P 500 plunged 24% and is well and truly in a bear market territory. At this juncture in time, we don't see a reversal of the downtrend, and we favor further weakness to 3,400 points over the medium term. We expect volatility to remain elevated in the near term as markets are still digesting the higher Fed interest rate expectations, and while a rise to 3,780 points to unwind the oversold momentum conditions is on the cards, in the short term, the index is likely to struggle to stage a sustainable rebound at this point. Thank you very much for watching. See you next time.